AML laws and regulations in Europe play a crucial role in preventing money laundering and terrorist financing activities. In this part of the course, we will explore the key AML requirements and regulations that financial institutions must adhere to within the European financial data spaces. Legal framework. The legal framework for AML compliance in Europe is primarily governed by the European Union's EU 4th and 5th Anti-Money Laundering Directives, AMLD. These directives aim to harmonize AML laws and regulations across EU member states. The 4th Anti-Money Laundering Directive, also known as AML4, is a crucial piece of legislation in the European Union's EU efforts to prevent money laundering and terrorist financing. It sets the legal framework that member states must implement to detect, prevent, and deter money laundering activities. AML4 places obligations on a range of entities, including financial institutions, lawyers, accountants, real estate agents, and trust and company service providers. It requires these entities to perform customer due diligence, establish risk-based controls, conduct ongoing monitoring, and report suspicious transactions to the relevant authorities. Risk-based approach. A fundamental principle of AML compliance is the adoption of a risk-based approach. Financial institutions are required to conduct risk assessments to identify and assess the money laundering and terrorist financing risks they face. The level of due diligence and monitoring measures should be proportionate to the identified risks. Customer due diligence. CDD is a critical component of AML compliance. It requires financial institutions to obtain and verify customer identification data, such as name, address, date of birth, and beneficial ownership information. Enhanced due diligence, EDD, should be applied to higher-risk customers such as politically exposed persons, PEPs, and their associates. Politically exposed persons are individuals who hold prominent public positions or have close relationships with such individuals. AML regulations place additional obligations on obliged entities when dealing with PEPs. They are required to conduct enhanced due diligence to mitigate risks associated with potential corruption or illicit activities. Ultimate beneficial ownership, UBO. Understanding the ultimate beneficial ownership of legal entities is another significant requirement under AML4. Entities must identify and verify the individuals who ultimately own or control their customer, especially in cases of complex ownership structures or opaque jurisdictions. This information helps prevent the misuse of legal entities for money laundering or other illicit purposes. Record-keeping requirements. Financial institutions must maintain accurate records of customer identification, data transaction records, and supporting documentation. These records should be kept for a minimum period as prescribed by local AML laws and regulations, typically ranging from 5 to 10 years. Reporting obligations. Financial institutions are required to report suspicious transactions to the relevant competent authorities. Suspicion may arise from transactions that are complex, unusually large, or have no apparent economic or lawful purpose. Reporting entities should have appropriate systems and procedures in place to monitor and identify suspicious activities. AML training and internal controls. Financial institutions must establish and maintain robust AML training programs for their employees. Training should cover AML laws and regulations, red flags for suspicious transactions, and the importance of customer due diligence. Furthermore, effective internal controls, including segregation of duties review processes and independent audits, should be implemented to ensure compliance. Data protection and privacy. AML compliance should be conducted while considering data protection and privacy laws. These laws aim to safeguard personal data and limit data sharing to authorized individuals within the organization and competent authorities for legitimate AML purposes only. Regulatory authorities. Within the EU, each member state has designated a competent authority responsible for overseeing AML compliance. Financial institutions should be aware of their local regulatory authorities and their reporting obligations. Additionally, the European Banking Authority, EBA, provides guidelines and promotes consistent AML practices across the EU. Enforcement and penalties. Non-compliance with AML laws and regulations can lead to severe penalties, including financial penalties, loss of licenses, reputational damage, and criminal charges. Financial institutions should actively monitor changes to AML regulations and ensure ongoing compliance to mitigate these risks. Future developments. AML laws and regulations are continually evolving to combat changing money laundering and terrorist financing techniques. Financial institutions should stay updated with regulatory changes such as the 6th AML directive and adjust their compliance programs accordingly. In conclusion, understanding and complying with AML laws and regulations in Europe is crucial for financial institutions operating in the European financial data spaces. Based on a risk-based approach, thorough customer due diligence, and the implementation of robust internal controls, financial institutions can effectively mitigate the risks associated with money laundering and terrorist financing activities.